What is up? This is the Working Investor. In this video, we're going to go over QLDY from Defiance that just came out. We're going to talk about the good, the bad, the ugly, what I know about this fund and what I do not know about this fund because I don't see the put credit spreads posted, and why I am generally bullish in this type of theory of construction of a income fund that I made a video about this 3 months ago when I had the preliminary prospectus. And it all depends on the art of how they execute it. As always, nothing here is financial, tax, legal advice, or any sort of advice. This is purely for fun and entertainment purposes only. Let's get into the video. So we're going to gloss over what the fund does, give you a basic understanding, and then we're going to go delve into the type of flavor of risk you're taking on or reward you're taking on. So it's basically giving you exposure to the Nasdaq 100. It's called the Nasdaq 100 LightningSpread Trademark Income Fund. Is it quality or is it quality? That's the question, right? So basically, it's an actively managed fund that's going to seek frequent income. Frequent meaning that it's going to do 0 day to expiration put credit spreads at the money or near the money. And it's going to pay you twice a week, which definitely going to give people that dopamine hit. It's like dopamine in a bottle, this type of fund. So it seeks this frequent income by trying to maintain exposure, indirect exposure to the performance of the Nasdaq 100. And we'll talk about that. And because it's a defined risk trade, there's a limit to the potential gains you can make from the income portion things of it. QLDY is the first ETF designed to make distributions twice a week. So this is really going to get a lot of people going, aiming to deliver more frequent income than traditional income-focused funds. The fund uses the proprietary LightningSpread trademark strategy, which combines two approaches. Very important to know each of these. So number one, there's a synthetic equity exposure through deep in-the-money call options on the Nasdaq 100, providing participation in equity market performance. Number two, daily option premium generation through a systematic sale of 0 day to expiration put credit spreads or put spreads, seeking to capture rapid time decay from the short dated option, because you have massive theta decay from these 0 day to expiration options. So they blend these two, so by blending these exposures, QLDY seeks to provide investors with consistent income opportunities along with measures equity participation. The strategy is designed to balance potential growth in premium income while recognizing the risks of option trading and market volatility. It sounds like such a good sales pitch, and there's a lot of things I like about it as well. But look at their investment objective. The primary investment objective is to see current income. That's number one. Number two, the fund's secondary objective is to see capital appreciation. So that is secondary, even though they're trying to give you capital appreciation, but that is secondary. And they make no guarantees and everything. They don't know yet what percent will be considered classified as return on capital because it's so new. This thing just came out. You could see right here in September 17, 2025. It has an expense ratio of 1.04%, so 104 basis points. I mean, the AUM is 2.54 million. This thing is just a baby, just launched like a few days ago. And if you look at their holdings, you see the number one holding is this top holding right here. It's the NDX. It looks like they have 4 contracts of it, possibly. It says 4 NDX. And it's a very deep in the money call because it's the 1001 strike price. For reference purposes, the NDX is trading at $24,626.25. So the 1001 strike price, this thing would have to go down about 96% for it to breach that strike price, 95, 96%. So you are talking about insane events in the world to happen for this thing to breach. But of course, there's no guarantees, right? But it's extremely deep in the money, to say the least. I want to ask you guys what's missing here. So you see here on top thing, the NDX long calls, that gives you the upside exposure, which is uncapped. And then you look at that it comprises of almost 93% of the weight of the fund. Then you got some cash and you got some treasury products. What's missing, right? I even downloaded the holdings to see if, what's missing. And if you guys didn't guess it by now, I do not see the intraday trades for Friday or Thursday. I don't see the posting of the put credit spread. It's very important for me as an option trader to understand where they're putting the put credit spread. Let me give you an illustration. So let's say you have this black line here. I have ATM, which means at the money, right? So where are they putting? So there's something called, so there is a deep in the money call. We'll ignore that for now. But relative, we're focusing on the put credit spreads. So are they writing it at the money? Are they writing it out of the money right down here? So it gives, what does that mean? It means that if the market goes down a little bit, it will not breach your put spreads, because if it breaches your put spreads, then that's when you take on more losses relative to the losses of the market. Or is it in the money, which is even worse, right? So what do I mean by that? So the prospectus has I advise you guys to look at page number 2. Look at the whole entire prospectus, but I want to guide you to page number 2 because I find it very explanatory. So, I mean, you saw here the ingredients of the lightning spread strategy, which I highlighted, the long call and the put credit spreads. We know that, the 0 day to expiration. And here, this is very important. They're writing their put spreads at or near the money, which I'm not the biggest fan of writing stuff at the money or near, I'd rather than be like maybe near out of the money or out of the money, a little further out of the money. And they have an excellent example that explains some of the risks that you take over here. They say that, and I'll illustrate it over here. Let's say the market is going down, right? So the red is the market going down. So because you have exposure via the synthetic long call, the leap option that they have, right? You're going to go down as well, almost 1-to-1 with the market. I mean, that's the risk you take with holding the long. You go up with the market and you go down with the market, right? But what is the additional risk that you take? The additional risk that you take is that, let's say, for example, you have a put spread, as you could see here on the right, and let's say, for example, it's a 2% wide spread. That's the width of the spread. The short spread and the long spread, the sell put and the buy put, respectively. And the market breaches through both sides of this spread. So it breaches through first the short put, and then it breaches through the long put. So now, let's say the market goes down 3% for the day. It was a bad day in the market, in the Nasdaq. You're going to be down 5% because you take on the additional risk of the width of the spread. So if it's a 1% wide spread, your additional risk for the day is 1%. So you can lose, relative to the market, additional 1%. If you have a 2% wide spread, your loss potentially could be whatever the market loss is plus the additional bonus loss of 2%, and that's per day. So I made a little picture of a monkey covering its mouth over here just for fun purposes, but they said that they write the strike price at the money, which is right where the stock price is trading, the black line, and they said, or slightly out of the money. So it's kind of like where this creature, this funny character is. So the thing is, you're not giving much wiggle room for the day because, overall, I'm very bullish on the Nasdaq 100. If you go on max time, you see it goes up and to the right. But there are a lot of times, like, if you zoom in a little bit more, you see a lot of chopping over here these days that it goes down, pretty hard. You can go, you can zoom in and take a look, you'll see. So if the strikes prices are a little bit out of the money, that means you give yourself a little bit of breathing room. If the market breaches it, it's not the end of the world because, the market might not even breach it if you give yourself some breathing room. I did a deep analysis with the updated version of ChatGPT. I had to think for a lot of seconds to come up with this. Let me show you. I was asking it, in the past 10 years of the Nasdaq 100, what is the percent of the days at the end of the day, the market ended up below the opening price? So per the chat, about 53% of trading days in the past 10 years, the past decade, it traded slightly below the opening price. So slightly below the opening price for a normal investor who is a long-term holder, they're not going to sweat over it because they know that you saw the big picture. It goes up and to the right. Who cares about what happens, the noise in one day? The problem is if you're having a spread right at the money, those 53% of days is definitely going to breach, if it's at the money, and it's definitely going to breach most likely going to breach the short position. And then, it may breach the long position or may be somewhere in between, but it's going to cause some extra decay on your growth. So the next question is, how far out of the money is like a standard deviation? So over the past 10 years, per deep thinking of the chat, I mean, they say that about 1.4% out of the money it is a standard deviation move for the Nasdaq 100 based on its volatility that it has had over the past decade. That's what it said. I mean, when it comes to option strategy, you can always go for a 0.16 delta because that's about one standard deviation out of the money. But in practice, it says that 68% of daily closes fall between a plus or minus, within a standard deviation of 1.4% up versus down versus 1.4% up. So for it to fall 2%, let's say, for example, I don't know what the widths are of the strikes, but let's say, for example, if it's a 2% wide spread, and they're writing it at the money, so it would have to go a full 2%, if not more, to go past the long put. So they're saying a 2% is about a 1.4 sigma. Sigma is a unit of standard deviation. So it will be a 1.4 sigma event. It's rare, but it's not extreme. A 3% down day is a 2 sigma, is a 2 standard deviation event, approximately. That's why I'm hoping that they're selling it. They say at the money or near the money. I wish they would just be more near the money or at least a little further out. Like, give me some kind of, resilience that give the market some breathing room if it goes down. I don't want to always be challenged with my spread. A lot of very smart investors recognize a certain type of dynamic of this fund, and they look at it like a leveraged play, even though it's not per se a leveraged ETF. But if you think about it, it behaves like a leveraged ETF because if the market goes up, then you're going to go up, but you're going to have additional return because of the premium. So you're up more exponentially because of the premium. In addition, if the market's flat, then you're actually going to make more money because as long as it doesn't breach the spread, then you're going to have that premium. If the market is down, you're going to have a greater loss. So greater loss on the downside, greater gain on the upside. And if it's neutral, but it has to, you want it to be above the spread, then basically greater gain on the upside, greater loss on the downside. So that's how I look at it. I look at like a little bit of like a leverage play to an extent. So we spoke about this, the pros and the cons. Twice a week payment, uncapped upside. It will outperform, like we mentioned, if the market's up. The cons are the extra risk on the downside. Here are the questions that remain. If somebody has those intraday trades, that's the put credit spreads, I would really like to know, because I want to know, how wide are their spreads? Because the greater the width, it changes the whole metric of it. It changes a lot of things. How are they managing the spread? Are they staggering the spread? Are they putting all the spreads on first thing in the morning when the market opens at 9:30 Eastern time? Or are they kind of staggering them out? Maybe they're putting on a few spreads in the morning and then a few spreads a little later. Or are they doing, if there's a big event or a big meeting during the day where there may be some changes in the market, are they holding off and putting on spreads there? Like in Tap Alpha, they sometimes would look at the market and look at known events. So there's a lot of questions that remains. So am I investing in this fund? Right now I'm watching it. I would like to invest in it, but I have a lot of unknowns. So I don't know what I'm getting into. Anyways, I hope you guys enjoy. Have a wonderful trading week. Let me know what you guys think about this fund. Be well.